Copyright in these lectures is either owned by the ANU or a third party who has licensed the ANU to use it. Students may use the recording for personal study only. No lecture may be communicated online, copied or shared without the prior permission of the ANU.
A lot of things that you may use within your discretion to run your own equity portfolio, just a hypothetical portfolio, and you may backtest your own trading or investment strategy with it. And the data is totally free for you to use. So what we are going to discuss in the context of asset allocation is try to understand the roles, the characteristics of the equity in the total portfolio context. And we try to understand how our asset allocation decision, we're going to assign like 20% or 40% into domestic or world equities. How can this decision will help us to help our clients to achieve their objectives, given their circumstances, the constraints, and so on. So that comes back. Hopefully, this will last for the rest of the lecture. We're going to start our discussion by forecasting the expected return of equity as an asset class. We have talked about this topic in week 4, and today we're going to focus on one particular method, in which we're going to decompose the expected return of equity into risk-free rate and equity risk premium. That's actually a very commonly used method for analysts to forecast the expected return for equity. And then we're going to look at the characteristics, the contribution of equity into the total portfolio risk and return, and also within the equity portfolio, what will be the characteristics of risk and return. And lastly, we're going to have a look at the subclasses, sections within the equity asset class. There are some misconceptions and some misunderstanding about asset allocation, especially into emerging markets. And lastly, we're going to discuss things might be different from the perspective of Australian investors. More details will follow on in week 10. So equity is readily available and very easy to access for even ordinary investors. If you want to invest in equity markets, you can just open an account with CommSec and start trading and buying and selling any listed companies in the market. Equity market is usually liquid. Most of the stocks, especially the stocks in ASX 100, they are all large listed companies, very liquid, which means that if you want to buy or sell, that order is going to be filled pretty quickly. But for a lot of small cap stocks and some emerging market stocks, they are not that liquid. So in other words, the price discovery process is not as efficient as the liquid stocks. So there will be associated. Maybe I'll just stand here. Don't know what's going on. Especially when you invest in emerging countries, even with the largest blue chip companies, there are significant illiquidity risk. And I have shown you some of the smallest real estate investment trusts in Australia, and Asset Plus, for example. It's not really actively traded, even it's a listed Australian stock. If you're interested from some free sources like Yahoo Finance, you actually can find out the trading volume of some emerging market stocks. Even with some large companies in emerging markets, some emerging markets, the trading is actually not very active. There are a lot of reasons the ownership can be concentrated. The companies tend to be controlled by institutional investors, sometimes by government or family members. They tend not to really buy or sell very often. So when we talk about equity market, we are talking about a very broad range of securities. For example, in the US, it's probably the most efficient actively traded equity market. If you look at the trading volume of the Russell 3000, not every stock is actively traded. So even in the efficient active equity market, there are illiquid stocks. So if you're going to have an asset allocation by assigning some funds into equity index, you have to differentiate ASX 100 and ASX 300. The illiquidity risk with the small cap companies can be substantial in some circumstances. Equity market is extensively covered by media, and if you go to Factiva, which can be accessed from library, you do like a search within Factiva of any equity market related topics of your interest, you're going to see lots of media coverage. It's different from another major asset class, which is fixed income. With the fixed income market, investors are almost purely institutional investors. Individual investors like me, we do hold some fixed income securities, but I do not have direct ownership, or I do not go is even more severe. They are quite different, and it's not very often that fixed income security is covered by media or any other business sources as the equity market. So for a lot of investors, equity market is probably the first thing when they try to diversify from their human capital or their home, the property. And also the transaction cost, especially in Australia, is relatively much lower than fixed income securities. Regarding the contribution of the equity into the total portfolio risk and return, we understand equity is one of the major choice of growth assets. In addition to equity, we may have choices of other growth assets like property, hedge funds, private equity funds, but equity, which we mean the listed companies you can easily access or buy and sell, they are the major contribution to your total portfolio risk and return. And we are familiar with this chart, that for balanced portfolio, the total portfolio variation can be attributable to just equity market variation, up to over 90%. To forecast the equity market return, here I'm going to discuss one method which is very commonly used by practitioners. We're going to look at the equity market risk premium. So we understand there might be some investment in the market that will give us the minimum level of risk, for instance, government bonds, especially AAA rated government bond, like Australian federal government. And on top of that, to attract investors from these safe assets, you have to offer a certain level of compensation for that additional risk. That will be equity risk premium. It actually has been debated by academics until now. We try to decompose the contribution of the equity risk premium But so far, academics cannot agree with each other. How can we attribute this equity risk premium? We have proposed a lot of factors like risk aversion of investors, illiquidity. We look at the historical series of equity risk premium. They are not static. Back in 1980s and 90s, when we had usually in a lot of the major economies, we had double-digit inflation, the equity risk premium was 8% per annum, 9% per annum. So that's why you'll find in some textbooks, the equity risk premium is still 8%. Over time, this equity risk premium has decreased a lot. So far, I did some search on the latest estimate from the leading investment banks. In the US, the equity risk premium is about 3% per annum or 3.5% per annum. There's a quite still wide range of equity risk premium based on the March release of investment banks. So the lowest point can be only 2%, but the highest estimate of equity risk premium can be 5.5% from some investment banks. In Australia, I'm going to leave this task for you to have a search. Go to library, find Factiva. In Factiva, build your own research. And you can use the keyword of Australia, equity risk premium, and you will have some information on this. Have a look at what's the latest equity risk premium in Australian market. It's different from the US equity risk premium. So to estimate this equity risk premium as a major input into our forecast of expected return of equity as an asset class, we can use the just traditional, very boring, old school discounted cash flow or dividends discount model. So in this model, we're going to assume a constant, stable growth rate of G, and the K here is the required return for equity, and the dividends yield here, which can be estimated or observed from the equity market. So in the world average, or in the US, the equity dividends yields is about 2%, and the risk-free rate, what's the risk-free rate in US market right now? What's the cash rate? $1.5? That's the Australian cash rate. What about the US? Did you have a look at the Federal Reserve time series data, even their homepage? It's about 2.5%, about. And the constant growth rate. How do we estimate the constant growth rate of an economy or equity market? It's the nominal growth rate. What's the structure we're going to use to forecast the constant growth rate? So on average, how does the economy or the Australian equity, the price level, will grow at a certain rate? We talked about this in week 4. What's the constant growth rate? So we're estimating a nominal growth rate. We can decompose that into real interest rate, real growth rate, and inflation. The expectation of inflation in the US market is about 3%. What's the real GDP growth rate expectation in the US? It might be a tricky question given the trade war, the talk about the trade war and uncertainty with the the presidential election on the way. So do you have any idea? Sorry? Above 2%, yes. So basically, it's sort of very close to the long-term expected growth rate of US. So we have these inputs and plug the numbers in, and we might estimate that equity risk premium. Okay, mission accomplished. That's it. And we're going to use this number and into our modeling and try to estimate the expected return of US equity. Is that the end of the modeling? Is that so? What's the problem with this method? Or what's the common problem of any quantitative analysis or any quantitative model? What's the problem of this process? No, I'm not using historical data. And there will be uncertainty about the assumptions, the parameters you throw into the model, and there are uncertainties about the model. How confident are you going to be to use this model to forecast the equity risk premium? And sorry about this. With all of the parameters, they are sort of assumptions. With the dividends yield, if you look at the historical variation of dividends yield, they can be very volatile. I'll leave this job to you. But for Australian equity dividends yield, they can be as high as 8%, as low as negative 3%. The average is about 4%, a little bit higher. Actually, it's a lot higher than the US level and the world equity market level. So dividends yields, the forecast of dividends yields, it can change all the time. The expectation of risk-free rate tends to be, comes with more confidence because we know that the central banks, they tend to move the interest rate gradually. So to some extent, we do have more confidence in forecasting the risk-free rate. And the last problem will be the constant growth rate. And of course, there are a lot of factors driving that equity market growth or economic growth. So it can be quite uncertain. We are throwing uncertain parameters into a model that requires assumption like constant growth. So the output from this model is going to be 1 point estimate. With any quantitative analysis, we probably will need another quantitative model or your qualitative judgment. Have a look at the risks or uncertainties of your forecast, of your parameters, and probably you want to have a range of that equity risk premium. As an after-lecture exercise, you probably want to forecast the parameters for Australian market, for the dividends yield, risk-free rate, and constant growth rate. Have a look at the RBA website to find out the inflation expectation, the current risk-free rate. You might look at the medium to long-term government bond yield as a proxy of risk-free rate. With the dividends yield, actually encourages companies to pay out dividends because investors, on one side, they're going to receive the cash distribution of dividends, and the other side, they're going to receive imputation credits to offset some of their tax liabilities. So that's one of the reasons why in Australia the average dividend yield is much higher than the world average or than the US level. There are other reasons as well. For example, corporate governance. The payout of dividends is actually a mechanism to align the interest of the shareholders to that of the managers. So the manager has to signal to the shareholders, I'm paying out all of the excess cash within the company that we cannot really find any new investment projects that offers a much higher return. So they would rather pay out the dividends to shareholders, and shareholders will like to find other investment opportunities. And also, the tax system in the US and in Australia are quite different. In the US, investors are subject to different tax rates on capital gain and distributions or dividends. And they have to pay different rates for the federal tax and state tax. So the tax system is not really encouraging much higher payout rate, dividends yield in the US market. But in the Australian market, the existing tax system, especially the imputation credits, it encourages Australian firms to pay out more dividends, instead of retaining the dividends, this amount of cash within the company, to invest them in non-positive NPV projects. Now we have a look at the historical estimate of the equity risk premium. We have this very complicated table of the equity risk premium over different government securities or risk-free rate. And we have arithmetic mean and geometric mean over different sample period as well. So with the first columns of statistics, we have the sample period that includes the Great Depression. So we understand the impact of the Great Depression on the world economy and especially in the US market. So less standard deviation, very similar geometric mean of the return from the stock index. So that will make some difference in selecting different sample period. Now we move on to the risk-free rate when we use different maturities of that government bond. Net of one-year treasury is much higher than the net of 30-year government bond. So with the short-term government bond, it's intuitively less risky because you're going to receive your principal, receive the coupon only in 1 year of time, and that comes with much less risk than investing in government bond for much longer term, 30 years. So the premium is much higher. That's the historical estimation of the equity risk premium. If we use some lighter periods, we remove the impact from the Great Depression from the sample, and probably this estimate will be much more relevant for forecasting for the future, because in 1930s, that was extreme equity market volatility, and the equity market around the world slumped for extended, very long term. So we actually have an historical estimated equity risk premium about 6% over short-term government bond and about 2% over long-term government bond. So there are a lot of very much difference of the risk-free rate you're going to use when you calculate the equity risk premium. And if you look at that, the last, we have the net of long-term corporate bonds. How can this be useful in investment decision and the asset allocation? So, for example, I have an investor for example, just the clients in your assignment. And now you're going to forecast the expected return for Australian equity and world equity by this method. Assuming a risk-free rate in the two markets, and you estimate an equity risk premium. So now we have this estimated equity risk premium over 1-year government bond, which is 4%, and over 10-year government bond of 2% premium, and over investment grade, that's the last one, investment grade corporate bonds of 1%. If the investor is someone like the clients in your assignment, with investment horizon 10 years plus, how are you going to forecast the expected return in US and Australian market? Which rate are you going to choose? What's your preference? If the investor's investment horizon is 10 plus years, you're going to forecast the expected return by risk-free rate plus that equity risk premium for Australian equity market. So which risk premium are you going to choose? Louder, please. Why? Why do you prefer the equity risk premium over 10-year government bond? Yes. So the investment horizon is long-term. You probably want to have an equity risk premium based on long-term government bonds. So here we just happen to have 10-year government bond, and the investment horizon is at least 10 years. What if the investor's investment horizon is 30 years or 50 years for like someone like in your age brackets? There will be other choices of 30-year government bonds. And which one will be your preference? We're going to go to that. Try to align the investor's investment horizon with the maturity of that risk-free government instruments. Although they are not perfect match, but we are closer. What's the use of that equity risk premium over corporate bonds? In a lot of specific risk or company-specific risk, when we try to calculate the required return from that project, it might be more appropriate to use the equity risk premium over a corporate bond index. Does it make sense? When you have a look at, when you try to forecast the required return from a long-term project, the equity risk premium over a corporate bond index might be more appropriate in terms of the term, the term of the project, and also the very specific business risks involved in your calculation. So that's how we, our understanding of the different rates of equity risk premium can be used in asset allocation decision. So it really helps us to decide which rate you're going to choose, which equity risk premium you're going to choose. It's better to be aligned to investors' horizon. how come they are so different? So these are the factors that will decide the different estimate of equity risk premium, whether you're using a short-term government bond as a proxy of risk-free rate, or you're using a long-term government bond as the proxy of risk-free rate, or you're going to use arithmetic mean, geometric mean. They all come together. That's just a reconciliation how come they are so different. That's the survey. So this is an old survey, but this is the probably the longest term estimate I can find. It's actually released in 2005. It's for almost 50 years estimation period, very long-term view of these institutions of the average equity risk premium. So you will find some leading investment banks, Lehman Brothers, he's gone, and also some academics in here. So they actually, you will see the range of their estimates up to 4.2%. That's probably the highest academics are really. You will find people have different beliefs of equity risk premium. It's a measure of dynamic nature. But lastly, if we look at an average, it should be between 1 to 2% for very long term for the US market. And that is quite consistent. I did some survey of the equity risk premium of a few institutions with very long-term estimate of equity risk premium is still between 1 to 2%. But when you go to do the Factiva search, you probably will get estimate for short-term or medium-term, not this long-term, 50 years. So they tend to be higher in the US, like somewhat 3%. In the Australian market, a little bit higher than that. The overall equity market risk. I did a 10-year rolling standard deviation of the US equity market. You did that exercise with the Australian equity market in tutorial. So here I'm going to present the risk profile of the US equity market. And it's not really like the 10-year rolling standard deviation of Australian market that experienced a significant drop after 2000. And when the monetary policy came into effect, and we had the lucky ride of the resource boom, and the whole economy settled into a quite healthy pace of development. In the US, there's another picture, and we'll see the increasing of stock market volatility during the internet bubbles, and there's no surprise the standard deviation of the equity market go to about 16%. On a 10-year rolling basis. If you don't understand what's 10-year rolling, go back to check your tutorial. It's been discussed in tutorial. So the calculation of rolling statistics actually intends to dilute the impact from any major market events so that you will have a better assess of your investment experience over a long-term period. Another spike, not surprisingly, the global financial crisis. And how do we explain this? Why in recent months that the 10-year rolling standard deviation had this drop from 15% to below 14% in recent months. Why there's a drop? Donald Trump? I thought that's a risk factor for Australian economy. But that's, you're on the right track of thinking about the possibilities, the uncertainties. He is an uncertain factor. So, any suggestions? Can you recall that when you discussed the fluctuations of the 10-year rolling standard deviation of Australian equity market, what happened? What's so special with the 10-year rolling statistic? What market? Commodity market. That's the driver of the general performance of the equity market in the Australian economy. And here we're looking at S&P 500. What's so special about 2018 in a 10-year rolling calculation of standard deviation?
The influence of GFC.
Yes, exactly. That's why we calculate the rolling 10-year rolling statistics. For investors who have a long-term investment horizon, the temporary market volatility, the effect of the market volatility in 2018 is actually diluted over a long-term investment horizon. And in 2018, that's when that's the so-called kind of a milestone, especially in our calculation of the standard deviation. It's going to drop out of the calculation. So that's why you're going to see the drop of 10-year rolling standard deviation starting from the year 2018. That reflects the impact from the global financial crisis. Market standard deviation in the US. And it's quite stable. The equity market drivers, in terms of the valuation of equities, it's still the old school discounted cash flow. You probably have learned a lot on this from corporate valuation. So if there are any changes with the forecasted future cash flow or the discount rate, you probably will see the revaluation of the equity market in general. But there are other macro factors, and there are probably hundreds of thousands of papers the economy is trying to study. How can we forecast the equity market return? So we're going to focus on the resource utilization. I have asked you to read about the monetary policy and related. These are somehow related to how the central bank, they interpret the recent market development and their mechanism, their tools, their methods of manipulating the growth of the economy. Here we're going to look at one particular driver of the equity market return, which is the capacity utilization. This is from the Federal Reserve. You can go to download the same chart by yourself, and you can even configure this chart to have some exercise, just to try to play with this data. So within the data, we have the capacity utilization on the vertical axis. So it's a measure of how much of the resources of the economy is put into production, including human capital. So this measure is closely related to labor market performance as well, not just the economic growth. You will see a few vertical areas, the gray areas. They are periods of recession. So economic contraction as defined by NBER, National Bureau of Economic Research in the US. So it doesn't indicate any technical recession. Technical recession is just 2 consecutive quarters of negative economic growth. That's not actually viewed by economists as real recession. So here, if you're interested, you might go to search. Financial crisis, especially the height of the crisis, US experienced this extended time of recession, economic contraction, and at this time the capacity utilization was down to about 65%. So in other words, consumers are not spending money. There's very weak demand from consumers. So manufacturers, they react to the slump of consumer demand. They do not put much resources into production. There will be significant layoff of employees of the workforce, and many of the factories' equipment will be put into idle state. So about 35% of the resources they have are not producing anything. So that indicates that the economy is not doing a great job. What we are interested in is the recent development. So we understand what happened after the global financial crisis. Several rounds of quantitative easing, stimulus package from Federal Reserve, and they pressed the cash rate to very low level, even close to 0%. The real interest rate is actually below 0. So that's what happened so far. Federal Reserve has indicated a few times, actually, during this period, we're going to increase the cash rate gradually by very small margin, because we see that the economy is back to right track, and we're going to phase out the stimulus package we have put in there during the global financial crisis. And every time Federal Reserve indicated this, the stock market dropped a little. So that means investors didn't really welcome this end of the easing monetary policy. That's what you often observe when the capacity utilization drops below the level of 80. When you're going to very often to observe very easy monetary policy, so low cost of capital, and there tends to be emerging consumer sentiments or emerging optimism. Capacity. So at this stage, it's more likely you're going to experience robust equity market return in the next few years. But there are uncertainties, like what happened during this period. So that was actually a turning point when the capacity utilization was increasing to that sweet point, when the inflation risk was very low and consumers were relatively quite optimistic and manufacturers were optimistic, they were willing to make investment, but there's a downward trend that it turned out very significant risk during this period. So we still see the capacity utilization is still below 80%. Now, the Federal Reserve is, even within the board of itself, they are fighting. They are divided into several schools. One school believes, okay, we're done with the stimulus package, we should move up the interest rate further. or take other measures to phase out the stimulus. The other people, another group, believe, okay, there's still significant risk in the US economy. We need to wait and see. And especially there's another uncertainty or something in the political arena that will be the election, presidential election next year. In the US, there were several cases of interest rate cut just a few quarters before the presidential election. We can't really say they were under pressure to cut the interest rate, to stimulate the economy, to boost the investor confidence. But there's certain cases that in the history it happened. Donald Trump is very critical of the Federal Reserve. If you do like a Google search on the name Donald Trump, you're going to have a lot of things listed. Sometimes I do question, am I reading something about politics, economics, or just gossips? So he's very critical of the policy from the current Federal Reserve, and he believes they move the interest rate too fast and by too much upward, and he wants lower interest rate. Of course, that's going to be favorable to his re-election. So we're going to see how this is going to evolve next year. Saturation point that the majority of the capacity has been put into production. And at this point of time, you have very robust consumer sentiment and probably over-optimistic. They are spending, they're borrowing a lot to finance their exaggerated spending need. And at this point of time, companies tend to over-invest. And at this point of time, it's very often that we're going to find the central bank observes this over-investment or over-optimism from consumers, and they're worried about asset bubbles, over-borrowing from the private sector, so they tend to have tightened monetary policy when the utilization is close to 85%. So when the utilization is close to that so-called risk territory, you probably will expect the equity market will experience some negative returns in the years or quarters following that. If you're interested, you may go to have the time series of the S&P 500, calculate the returns, and you're going to have this data of capacity utilization and also the changes. Have a look at the correlation, or if you want to run some simple linear regression, remember, when you do simple linear regression with the economic indicators, they merely indicate some sort of correlation, not really very robust or very strong economic modeling, but they do indicate some correlation. So have a look, is there a lagging effect or leading effect of these two economic indicators, and how the correlation can you get from the two time series data? This is quite special for Australian investors because we receive imputation credits from our investment in Australian equity market. So that's part of the expected return of Australian equity. In the US, that's not an issue at all. So how can we forecast this effect from the imputation credits? Of one private investor and one superannuation account. The two investors, they both invest in Australian, for example, index, the same product, but in different legal structures. So with the private investor, you can invest in the same investment product, but you are in investment account. With the superannuation, it's probably an institutional account investing in Australian index fund. By different legal status of the two investors, they actually receive different tax treatment. We're going to demonstrate how the tax treatment will play an important role in the net return received by the two investors, the private investor and the superannuation account. So with the same investment, we're going to assume the same dividends, that's the distribution over the year, 5%, and realized capital gain of 5%. So over the year, total return for your investment is going to be 10% before tax, before fees. Next, we're going to calculate the applicable tax for the individual investor and for the superannuation account. So with the 5% dividends, we're going to estimate the imputation credits that come with the distributed dividends. So if you invest in Australian equities, when you receive the statement over the year, for instance, you find the section of dividends distribution, you will find a separate item of imputation credits. It's calculated in this way, the amount of the imputation credits. So that's the formula. The idea of imputation credits is like this. For most of the listed Australian companies, they generate most of their profits within Australian border, and they have paid Australian corporate tax, which is 30%. So ATO believe that, with the distribution of dividends is after tax profit generated by the company, and you have paid corporate tax. When you receive the distribution in the form of dividends, I'm now going to tax you again. So this is the way that how they include times 3/7 times 80%. 3/7, that indicates the ratio of 30% tax rate in your total profit taxable, and 80% is the franking level. So it's a rough measure that the percentage of profits generated within Australia, which is subject to the Australian corporate tax. So 80% is an average franking level of listed Australian companies. So here we apply this formula and calculate. For 5% of dividends distribution, the investor is entitled to 1.7% of imputation credits. So this is the way stated by the law, how it's going to be calculated and how it's going to be reflected in the tax return. So now we have the full inputs into your tax return in terms of dividends, and the total taxable income from dividends will be the sum of 5%, and your imputation credits, 1.7%. That will sum to 6.7%. This can be intuitively not reasonable. Okay, so, but this is the regulation by ATO. You receive dividends, cash dividends distribution, and you receive imputation credits, and it's taxable. It's part of your taxable income. And then the applicable tax is going to be calculated based on this 6.7% of taxable income. And here we assume a 45%, the highest personal tax rate. That will give you a gross tax liability of 3%. And now here's the time you're going to use the imputation credits. It's going to be used to offset your gross tax liability. So you're going to pay 1.3% for the dividends income you receive. Yes? Sorry, I can't hear anything. That's the way defined by ATO, how they're going to calculate the amount of the imputation credits. Tax for the personal individual investor. On the right, we have the superannuation account. Something different is the applicable tax rate. For any income, no matter it's capital gain tax or distribution, it's capped. The tax rate within superannuation account is capped at 15%. So there will be much lower overall tax liability and the same imputation credits, because the imputation credits is calculated based on the gross dividends distribution. And surprisingly, you're going to see a positive tax liability. So what does it mean for the superannuation account? What does it mean, a positive tax liability here? Sorry? Pay tax? Okay, the negative sign here for the personal investor, that means it's tax liability. They're going to pay tax to ATO. So for the superannuation account, they have a positive tax liability here. What does it mean for the superannuation account? Are you following the policies on this imputation credits by the Liberal Party and Labour Party? Actually, after filling in this tax return by the superannuation account, they go to ATO and ask for cash. Yeah. They're not going to pay any tax to ATO at all. Instead, they're going to receive cash refunds. That's probably one of the major policy differences between Labour and the Liberal on the imputation credits. Labour is trying to remove this cash refund of imputation credits. So a lot of institutional investors are going to be affected, especially superannuation funds. And in turn, a lot of individual investors, especially investors who are in mature age, they relatively have an asset allocation towards the cash or dividends generating securities. So a lot of people don't really like the policy by Labour on this. So in Australia, if you hold an investment for 12 months or longer time, you're going to have a capital gain tax concession, 50%. So in other words, if the highest personal tax rate is 45%, you only pay half of that tax rate on the realized capital gains. So that's what's happened. That's the half of the 45%. And you have the capital gain tax liability of 1.1%. For individual investor, the total tax liability is 2.4%, and the net after-tax return is 7.6%. On the right, you have the superannuation account, and that's the average or some kind of average rate of the capital gain tax superannuation accounts pay for the realized capital gains. So it's about 10%, and you will see With the superannuation account, they have a slightly higher after-tax net return for their members. So the numbers here are exaggerated a little bit to demonstrate the difference of the two investors, two investment accounts. But it is true that in Australia, the most tax-effective long-term investment is your super. Even if you do not actively manage your superannuation account, you just invest in the default balance option, and the tax benefits can be very significant. Let's take 5 minutes break, then we're going to finish off the second half of the lecture. Any questions about the exam or assignment? Have you started studying for the exam yet? No? I was just wondering, no one came to see me yesterday and today. I'm a little bit worried. Try to have 25 or 20% of correct. Any questions about the exam? No? Have you started working on your assignment? No? That's okay. You still have a few weeks. It's going to be quite intense, especially after week 7. To submit partial model by week 7. It was quite intense, put a lot of pressure on students. Although it was optional and students still complained there was too much work together with the mid-semester exam, so I don't ask you to do that. But you should aim to do something by week 7 during the teaching break. Okay, next we're going to talk about the risk and return within equity portfolios. So this section is part of the process of equity portfolio management and performance evaluation. We're not going to spend too much time on this. It's not the key contents in our asset allocation course, and much of these things are not really examinable. They are not required. For example, the Barra model, or how you're going to run an performance attribution, or how you might decompose the total return variation of your portfolio into different factors. They are supposed to provide you some introductory level of understanding. Probably it's going to be used in a way like, for example, when you are at the job interview, they mention something, it will ring a bell. Or when they talk about some Barra model and you can impress the interviewer, yeah, I know the Barra model. And if you can use this in this way, that's probably what we want to achieve from this part of discussion. So within the equity portfolio, we have sort of multiple dimensions of risk. One particular risk measure, which is tracking error, is very much relevant for almost all of the equity portfolio managers. They are, to some extent, under constant pressure to beat the beta or factor model. If you are running the return of your equity portfolio relative to a market index, you are estimating the beta. And also, we might introduce other factors so that you might have an estimation of the factor model. So what are the relevant factors driving your equity portfolio return? These factors, there's a very long list of them, like Fama-French 3-factor model, 4-factor model, and 5-factor model. Or sometimes you might have a differentiation in terms of investment style and industry exposure. So you have run your total portfolio return against several sector index to have a look at how much of your total portfolio variation can be explained by the industry effects. And lastly, the factor models. It's used widely by practitioners to understand the fundamental risks of an equity portfolio. The Barra model is used in a way that you have certain well-defined investment strategy of your equity portfolio. For instance, overweight the certain stocks, for example, value stocks, and underweight the growth stocks if you are a value manager. So you believe over long-term value stocks are going to outperform the growth stocks. So in this way, you have your well-defined investment strategy, and you know the asset allocation within the equity portfolio of your benchmark, and you have good understanding of the weighting within your portfolio. And you, by looking at the historical returns, if we're looking at the risk contribution or performance contribution, you can decompose the total portfolio variation into different factors. And in Barra model, they have several categories of fundamental drivers of the return variation. So here we have a few examples, whether the stock is value or growth, or its leverage level and its foreign sensitivity. So how the value of the stock, the return from effect, value effect, and yield effect. So in this model, you have an estimation of the exposure in terms of these factors of 1.64 for its size, and negative of 0.62 in terms of value, and yield, which is very close to 0. So these factors, the exposures, indicates the risk of the stock relative to the benchmark. So obviously, size dominates the return variation in this particular case. In a total equity portfolio context, this can be done for each individual holding within your portfolio. Investment style in equity portfolios. So the style is actually quite qualitative or vaguely defined term in terms of style. So some managers may claim that I'm a value investor, relative pricing investment style, but when you really go to read their investment philosophy and process, there are a lot of variations in terms of their investment decisions, the security selection, the signals they try to capture in their security selection process, and how they're going to really implement this investment philosophy. So here we have a study of the Australian equity portfolio managers. We have a few clearly or sort of still roughly defined investment style. On the left, we have the quantitative managers, and then the value managers, neutral, where these managers, they cannot really classify themselves into value or growth, and they have the growth managers and relative pricing, and these often. So these managers cannot be classified in any of these investment styles. So we run a correlation. We try to estimate the correlation of the portfolio returns of different managers. Above 0.5, that indicates a correlation that you cannot ignore. So sort of high correlation, or the correlation that's going to make a difference. So these bars, whenever you have the top of the bar indicates the correlation of two managers. So let's have a look. We're going to have the value managers first. They probably are the largest groups of all the style-based managers in Australia market. So we do have a few correlations of close to 0.6 in terms of their performance correlation. And surprisingly, some of the value managers, their portfolio returns, they do not really correlate with each other. So the correlation is at 0.2. So in other words, this is very close to 0. They are not correlated at all, which indicates that with these managers, they probably have similar way of defining value or similar way of screening the value stocks and implementing their investment strategies. But with some portfolio value managers, they actually might have this very low correlation. There's quite diverse range of definition in terms of value for the value managers. And also, we have looked at the relative pricing. So they try to do the security selection based on reasonable price for growth stocks. And still, we have a few of them at correlation of 0.6. And still, some of them are not correlated at all. So that means even though they claim to be this relative pricing of growth stocks, they have very distinct investment process. That's the case for Australian equity managers. Actually, in the US, if you run a similar study, you will find the performance of managers of the same style. They're going to correlate at very much degree than the Australian managers. Because in the US, their performance is usually benchmarked to a specialized or if you're a small cap company, if you're a small cap manager, your performance is valued against the average performance of all the peers managing small cap equity funds or the small cap index. However, in Australia, most of the actively managed equity funds, they are given a benchmark as a broad market index. So in other words, these Australian managers, they don't usually have very much tracking error risk to worry about. And what they do, actually, they try to still have an asset allocation which is very close to the capitalization weighted index. And then with some sectors or particular stocks, these managers try to select the securities they believe are going to outperform the average index. So in this way, they actually have very much creativity or very much room to do their security selection. Equity subclasses, that's another layer of the equity bucket. So at the asset allocation level, we are going to allocate funds into equity, fixed income, alternative, and cash. At lower level buckets within the equity asset class, we can have domestic, international, or sometimes we can have large cap, small cap, medium cap, or there are different buckets you might fill in depending on the need of the investor or the available investment opportunities. Something that has always been attracting a lot of attention from investors is actually the emerging markets. It's not a separate asset class, it's only a subclass of the world equity market. So if we look at the MSCI World Equity Index, there are about 10% allocated into emerging market equities. But it does not cover all of the listed equities in the emerging markets. It's done by sampling. Only probably the largest, most liquid and actively traded emerging stocks will go into the MSCI index. Whenever a company is considered by the company as a positive signal because being included in widely available or followed index, it's actually increased the visibility of the company. It tends to increase the liquidity and then in turn reduce the cost of capital for the company. So it's relatively considered a positive signal. With the emerging markets, we understand BRICS countries are emerging markets, and in recent years, there's sort of convergence of emerging market return towards the world equity market. So when these emerging market equities for a while considered to be a source of excess return or where you may generate exotic beta. After, especially after 1990s, in recent years of globalization and the liberalization of financial market in a lot of the emerging markets, foreign investors find it's much easier to invest in these emerging market equities. Now these exotic beta or excess return that you might expect to extract from emerging market equity has been decreasing. So for some investors, for more adventurous investors, they have turning their eyes to frontier markets. So it's not difficult to understand. The frontier markets, they tend to be much smaller, riskier than the emerging markets. For instance, Pakistan market, Vietnamese market. These are part of the frontier market. A lot of market intelligence companies, now they have the frontier market index to give you some indications of the return from these frontier, highly risky markets. So with the specialized funds, some equity funds, they have managers who are specialized in selecting undervalued or the stocks that they expect to outperform in the future on particular dimensions, the company's characteristics. For instance, industry or the stage of the companies, or sometimes they use the market timing technique to try to generate alpha in their equity portfolio. So these are the equity subclasses, and probably they represent the investment the slides should be like this. So accessing equity markets, for most of investors, you might have direct investment in the equity market by buying and selling the equities, or you might invest in funds of funds. Then in this way, you might have the potential to diversify the style risk of some managers. And also, you might invest in passive index, for example, the Australian share index fund provided by Vanguard, Colonial First State. A lot of portfolio managers, they actually provide this kind of products. And smart beta, they are sort of enhanced indexing. So instead of capitalization weighting, they try to introduce other factors of weighting. For instance, dividends yield or franchise value. You might name a lot of these different smart beta indexation technology techniques to try to beat the market. And also with the very actively managed equity portfolios, a lot of managers might use leverage. And for instance, this active extension that you might raise $100 million from investors, and you enter into $130 million of long position and $30 million of short position. So you are going to introduce risks, or you're going to bet on your long position and short position to generate alpha. And long-short hedge funds is not necessarily market neutral. So the long-short position may not cover each other exactly. So you probably will have some long exposure to the long position or the short position. So all of these investment strategies are actively managed. It's very often you're going to observe like 400% turnover rate for the actively managed equity portfolio. With the passive index funds, the turnover is very low. And with some equity funds, they are sort of between the extremely active and the passive. They still have like 100% turnover ratio over a year. So that's how investors three-year rolling returns For emerging markets, that's the red line here. That's the red line. The emerging markets, the green line is Australian index, and the blue line indicates the MSCI World Equity Returns. First, let's look at the emerging markets and its volatility relative to Australian equity market and world equity market. When you look at a 3-year performance that represents a medium-term investment horizon, and obviously emerging markets, it tends to be more volatile than Australian equity and the world equity. And it's not hard to understand because of the high risk coming with the investment in emerging markets. And for the Australian equity, that's the green line over here. I'm going to choose a different color. So that's a turning point. That's a turning point when you compare the performance of Australian equity relative to the world equity returns. That's the start of 2000, or the start of the resource boom. Australian equity started outperformance, consistent long-term outperformance against world equity, starting from the early 2000s. It came to an end at about 2013, this time. 13, 14, and 15. And over 15 and 16, we see substantial underperformance of Australian equity relative to the world equity. Why we have this kind of relative performance changes in this way? I think 2 weeks ago, I asked you to go to ABS website, have a look at the pie of Australian GDP, and have some calculation of the contribution from different sectors into GDP growth rate. Did you do it? No. The largest sector contribution into GDP is service sector. So in terms of the growth rate, significant contribution is from the export of minerals. You probably still need to have a look at the GDP contribution yourself. That's why you see the Australian economy, Australian equity market experience this outperformance for such long term, and starting from 2013, 14, 15, for 3 years, it underperformed world equity market. Why? Because Australian economy is so closely related to the economic development in the emerging markets, particularly through the foreign trade tie, the export of minerals. In 2013, 14, 15, there was an extended term of collapse of commodity price. Not just fuel, a lot of commodities, which are very important for Australian economy. And another layer of this problem is actually, if you look at the major contribution to the size of the GDP of Australia, the service sector. So how can we have this strong, robust, long-term consumer consumption? Where do we get the money? Actually, starting from the end of 1990s, with the boom of the iron ore and some other commodities, there's a huge amount of cash coming into Australia. So either through investment, foreign investment, or these export, the foreign currency, the cash Australian companies have received by exporting to the emerging markets, exporting coal and oil and even petrol, a lot of commodities. So with the huge amount of cash accumulated in the bank account of Australian households and their wealth, especially their property, that's actually supported the development of the service sector in Australia. So it's kind of, we have been really lucky in a very nice, harmonized cycle of selling, exporting minerals, coals, and then within the country, employees, or in other words, consumers, are really optimistic about their job security, of their Australian dollar is a commodity currency. So the value of Australian dollar is closely related to the commodity price, the commodity market movement, or in other words, the expected economic growth of the major mineral importers. So it's not surprising that during the several years of 2013 to part of 16 actually, because of the impact from the collapsed commodity price, Australian equity market didn't outperform the world equity market anymore. Now we're come to this kind of convergence. The data is very close to until the end of February. So right now, we are sort of convergent at this level of return, emerging market, Australia, and world equities. So investing in emerging markets actually comes with other exposures. When we consider a diversified portfolio of a typical Australian investor, for instance, we have 30% of Australian equities, 30% of world equities hedged to $8, and we probably will have another like 20% in fixed income, another 20% in alternative and cash. With this diversified portfolio, we actually have more exposure to emerging markets than we believe. How can we understand this? Australian equity is closely related and driven by the demand by the emerging market. So somehow, when you invest in Australian market, you have an indirect exposure to emerging market. With you are in 30% investment in world market, okay, so within the world market index, there's about 10% of emerging market exposure. So on your total portfolio level, that's very close to 3%. But with the world equity index, a lot of the largest companies, they actually generate a significant portion of their profit from emerging markets. So with this, all of the equity market exposure, you do not hold any emerging market equity directly, but there's only 3%. Introducing additional asset, or when you try to generate alpha by overweighting a particular subclass of an equity class, you probably want to consider this kind of implicit exposure, especially in the case of exposure to emerging market. To further confuse you more, now I did this analysis from the perspective of Australian investor and US investor to highlight things might be quite different from the perspective of Australian investor because of the foreign trade tie with the emerging markets, and especially $8, the role played by $8 here. So what I do here is with the blue line, that's something you will find here, is that I run the emerging market return relative to the world equity market return in US dollar. So that's probably the experience of US investors or other investors who really settle all of their investment by US dollar. That's the most important settlement currency. So what's the beta I have here is actually this sensitivity of my emerging market investment relative to the world equity market movement or the world economic development. So I'm going to estimate the beta as indicated by the blue line here. The average is about 1.2. So in other words, the beta of emerging market in US dollar, oh sorry, I should just make it clear. Is 1.2. So in other words, if I believe the world equity market is the real market, that's the optimal market portfolio, my investment as a US investor or my investment portfolio is settled in US dollar, I'm going to observe a 1.2 beta. So this higher risk than the world equity. A beta of 1.2 indicates higher risk than the market. Analysis, but I have time series data in $. So I convert all of my investment back to Australian dollar and estimate the beta again, and here should be 0.8, maybe 0.8 or 0.9. So that's the average. When I run the same analysis, the beta of emerging markets in $, is 0.8, but my market is 1. The market beta is 1 in $. So it means that investing in emerging market for Australian investors who settle their investment or in $, they have an investment of a beta which is less than 1. What's the implication for in the context of asset allocation? This one? Yes. So I'm going to hold a diversified portfolio. The first one is an Australian investor, and the second one is a US investor. Where the first Australian investor is something that we can consider I hold most of my assets in $. And whenever I have international investment, for instance, investment in world equities, in US government bonds or international fixed incomes or alternative assets, I hedge all of my currency exposure back to $. So in other words, I do not have exposure to foreign currencies. I hold everything in $. That's my total portfolio. Now I hold 30% of Australian equity, 30% of world equity, and world fixed income of 40%, all in $. It's something like you have received in your assignment. So all of the return index are in $. returns. That's, I believe, for Australian investors. I'm going to spend the rest of my life in Australia. I'm going to pay my bills in $. I'm going to pay my medical bills in $. Spend my money buying the groceries from Coles. market exposure into my total portfolio, what do you find here? To understand risk and return for investors, we need to assess the risk and return at a total portfolio level, right? Remember this from the 3 enduring message from the modern portfolio theories. So we're going to look at the new asset or subclass of assets, its correlation with my existing assets or with my existing total portfolio. What do you find if I have emerging market exposure? And especially I want to hedge my emerging market exposure, and it's going to be in $8. What's the major driver of risk of my current portfolio? Any suggestions given this as allocation? Well, okay, let's start from here. If I have a balanced portfolio of 60% of world equity and 40% of world fixed income, what's the most important driver of my total portfolio variation? Up to 90%. What is it? Yes, equity, world equity. So now I have a portfolio of 60% of equity, including domestic and world equities, and 40% of world fixed income. What's the major driver of my total portfolio variation? Interest rate? That's too far. No. Still world equity. Equity, yeah. So with this existing portfolio of 30% domestic equity, 30% world equity, and 40% of world fixed income, the key most important driver of total portfolio variation is still world equity index. Remember the bar chart I have talked. %90 of the total portfolio variation. So with my Australian investor, about probably 90% of the total portfolio variation can be explained by world equity. Now I'm thinking I'm going to have additional exposure to emerging markets. What's the impact of my total portfolio return and risk? What's the potential? Am I going to be better off? Look at this. I'm an $8 investor. So if I have additional exposure in the emerging markets, I introduce sort of as additional exposure which potentially has a beta less than 1 relative to the world equity market in $8. Is that a good idea? Is it a good idea if I have additional emerging market exposure? So the most important risk contributor of my current portfolio is world equity. Now I introduce another subclass or a new asset, so-called new assets, which has a beta of less than 1. Am I going to better off? What do you mean premium?
Risk premium, because the risk premium is dependent on the world equity as well. So,
which risk premium you're talking about?
like your asset allocation is dependent on the world equity. So,
Okay, I have this asset allocation. This is my diversified portfolio. The single most important driver of my total portfolio risk is world equity. Now I have a new asset which has a beta of less than 1 relative to that world equity. Might potentially reduce my total portfolio risk. And remember this, for when you hold this diversified portfolio, risk should be assessed at the total portfolio level. That's the case for Australian investors. We hold everything in AE dollar and in this way. And now we have the US investors on the other side of the Pacific Ocean. They settle everything in US dollar and they hold their domestic equity 30% and world equity 30% and world fixed income of 40%. What's the major driver of their total portfolio variation? Yes, equity, world equity. Because even though we have 40% of asset allocation in world fixed income, but it's still closely related to the return of world equity market as well. Although this correlation may change, not stable, but when you run a total portfolio return variation, 90% of your total return variation is going to be driven by the equity market exposure. So that's the case for US investors. I want to introduce my exposure in the emerging markets. I want to buy some listed companies in Chinese market, in South African market, for instance. What's the potential impact if I introduce an asset or asset class which has a beta over 1 relative to the major driver of my total portfolio risk? Do I introduce more risk? Yes, potentially I do introduce more risk into my total portfolio. So with the Australian investors, we potentially might reduce the risk of our total portfolio. And for the US investors, we might potentially introduce additional total portfolio risk when we include additional exposure to emerging markets. And what about the expected return? If I assume the emerging market is going to outperform Australian equity market, US market, and the world equity market, what about the the expected portfolio? Evaluate any investment choices, investment decisions. We try to assess these potentials at total portfolio level. If I introduce a new asset which has much higher expected return than all the assets within my portfolio, what's the potential? Yes. So if I do have belief that emerging markets